Greetings and welcome. Dr. Scott here, and let's talk inventory. We're going to talk about LIFO, last in, first out, FIFO, first in, first out, and average cost. We're going to be focusing on periodic inventory, which means we take the inventory at the end of a period rather than the perpetual. Sell, buy, with all these cost layers. But before we do all the detail work, let's get a broad overview of what's going on with inventory as a whole. So I'm going to go ahead and pop onto a whiteboard and I'm going to ask you a question. We're going to go in and have a very brief discussion on profitability. You remember gross profit. I hope you remember gross profit. You remember that we had our sale, called selling price. We had our cost of goods sold. And then we ended up with a gross profit. And if you recall, our multi-step income statement has the subtotal for gross profit. Now, I'm going to ask you a couple of questions. I'm going to go through and we're going to do some different calculations, and we'll do something with LIFO here, last in, first out. We'll do something with FIFO over here, and that'll be our first in, first out. And we'll do something with average cost over here. But first, we need to introduce something called cost layers. So I'm going to go through some examples. Let's say we had a beginning inventory of 5 gallons of milk. And that was for each gallon of milk was $1 a gallon. And then on January 5th, I'll make it an X1 date, we bought 10 gallons of milk. And that was going to be at $1.50. Okay. And then, actually, I think I should get the right symbol there. We've got 1 there, okay. And then on January 20th, still in the month X1, the year X1, 20 gallons of milk at $2 a gallon. And we'll make it easily readable and consistent. And now we're going to have a sale, and we'll do cumulative sales at the end of the month. And we'll say we sold 1 gallon on January 25th for $3. Now, the bottom line question I'm going to ask up here is based on that $3 sale, and we're going to have our $3 sale here. There. We're going to have our $3 sale right here. And I'm going to have our $3 sale, same one, same place, same bat time, same bat channel, for $3. Big question is going to arise. Are we selling the $1 gallon, the $1.50 gallon, or the $2 gallon? So when we sell on a last in, first out basis, we're going to sell the last gallon that we got. So there's our $2 gallon. I'm going to go ahead and put $2 in here for our cost of goods sold. And on a first in, first out, I have to go in and calculate, figure out which one I sold. So the first one that was already there was the beginning inventory of $1. I'll get to average cost in a while. But then my next question is, what the heck is gross profit here? So if I look at that, I calculate 3 minus 2. I don't need a calculator for that one. I get $1 in gross profit. And here I go in and say, cool, I can do that. 3 minus $1, I make $2 in gross profit. My first question to you is, which would you rather make, $1 in profit or $2 in profit? By the way, average cost has to be between that, somewhere between $1 and $2 cost, somewhere between $1 and $2 profit. So my question to you is asking, would you rather have $1 in profit or $2 in profit? Now, gut feel says, I'd rather have the $2. That sounds like a winner to me. But I'm going to give you a different answer because I'd rather have the buck. Why would I rather have a buck? Think about that for a second. I want less profit for selling the same gallon of milk. Well, that could mean that if I have less profit, I pay less taxes. So would I rather pay, if we have our 20% tax rate, 21% federal corporate tax rate, would I rather pay 20 cents in taxes or 40 cents in taxes? Well, I'd rather pay 20 cents if I'm selling the same gallon of milk, except it depends. I may want to show $2 in profit if I have a business that I'm either the CEO and I want to show people how wonderful I am at managing and making money, or I might have a small business that I'm planning to sell at the end of the year and I want to maximize my profits. I'm willing to pay that extra taxes, that extra 20 cents. Doesn't sound like a lot, but it adds up real fast, especially double the taxes. So it really does depend. This is GAAP, generally accepted accounting principles. We can use LIFO, FIFO, or average cost, or specific ID. We know what nobody does for gallons of milk. Anything that's mass like that is not specific ID. A diamond ring might be specific ID. A car, a house, a boat might be specific ID. But if we're selling boxes of cereal or gallons of milk, we're going to have it batch it together. So I'm looking at this saying, okay, this kind of actually almost makes sense. I'm going to sell whatever it is. Now, if I told you instead of selling 1 gallon of milk, maybe I told you I sold instead, let's do 10 gallons. Let's see the dates we have here. We'll do 10 gallons on the, oops, all right, I'm not able to open that up again. I should be able to. All right, there we go. So if I have 10 gallons that were sold on January 15th, next one, and I sold another 5 gallons on January 25th instead. So what does that mean? Well, instead of having, if I was actually doing this perpetual stuff, I'd have to go in and say, well, which 10 gallons did I sell? Well, on a first in, first out, I have 5 gallons I sold of the dollar stuff, and then 5 gallons of the $1.50 stuff. On a last in, first out, it would be all 10 of those January 5th. I told you we're not doing perpetual. We don't have to go line item by line item or cost layer by cost layer. We're going to be able to go to the bottom line at the end of the month and say, well, what happened on January 31st? So on January 1st, I sold 15 gallons altogether. Now, there's a magic formula that also comes with inventory. With inventory, you start with beginning inventory. You add purchases, and you have a total of something called goods available for sale, or gas. And then you will subtract items. You either subtract the cost of goods sold or goods sold, and that equals your ending inventory. Or you subtract your ending inventory and you end up with cost of goods sold. Goods sold. So if you think about it, that makes sense. There's two things that can happen. You can sell the stuff or it's still here. I'm not going to be talking about shrinkage right now. Actually, I will talk about shrinkage. Shrinkage it's lost, it's gone. Either stolen at the front door, stolen out the back door, or clean up on aisle 3 when it spilled milk. Maybe a gallon dropped. Maybe someone an employee grabbed a gallon of milk to bring up to the break room. It's no longer inventory. It's not something in stock. So you treat that as sold goods. You count your ending inventory and you say, well, the rest might be there. So in this situation here, if we're looking at what our beginning inventory started at, and we know we started with our 5 gallons, and then we know that we bought a total of 30 more gallons. That means we have goods available for sale. You guessed it, 35. And if we sold, put that over here, if we sold a total of 15 gallons, then we go back down here and we have 35 minus 15 is 20 left in ending inventory. Better be 20 left in ending inventory. And let's go put the equal sign there to make it visual. So we look at that and say, okay, that's cool. I have exactly total of 35 items to be goods available for sale to be accounted for. I sold 15, I got 20 left. Or I got 20 left and I sold 15. Whatever it is, that inventory formula is sacrosanct. Let's talk about average cost now. All right, well, actually, let's do some numbers up here. Let's go back and we'll go back to LIFO. And we're going to change this number from $2 and $1. And we're going to say, well, if we sold on a LIFO basis 15 units, well, which did we sell first? On a LIFO, did we sell the beginning inventory or did we sell the January 20th inventory? If you're thinking the last stuff we got, yeah, we sold the $2 stuff first. As a matter of fact, all 15 of the gallons we sold were $2 inventories. So if I go here, I'm going to go 15 times 2 equals 30. That's $30 worth of inventory. And if I'm selling at $3 a gallon, I told you I sold 15 units. So I got 3 times 15 is equals, again, if you can do this in your head, you're ahead of the game. That's $45. So my gross profit here happens to be $15. Now, if I go back to FIFO, numbers are going to change a little bit as well here. Let's take a look at what they look like. If I sold same 15 units at $3, selling price isn't going to change. We'll do 3 times the 15. And that equals our 45. But our cost of goods sold is going to change. So in this case, first in, first out. What are the first ones? Oh, we got the dollar stuff here. So we sold 5 at $1. Let's go ahead and put that in. $1 times 5, plus a couple other things. If we sold a total of 15, oh, we sold 5 of those and 10, all of $1.50. 10 at $1.50. So that's 10 times $1.50, which should, if all goes well, so we got $5 plus $15, we should have $20. And if we take $20 from 45, that leaves us with $25 in our gross profit. So when prices are rising, as you just see, gross profit is higher with FIFO or is lower with LIFO. Now, I could tell you out of the gate. Now, let's do a little calculation here. I'm going in and I realize that my total line item here, I've got 5 gallons at $1. I got $5 worth of milk here. And I go 10 gallons times $1.50. Again, you don't have to get too fancy with math. And you got $15 here. And then I do $2 at 20, and I've got $40 here. So I go back up and I say, you know what? My average cost, now I need to calculate average cost. My average cost, I've got a total of how many units goods available for sale? Well, if I have 5 plus 10 is 15 plus 20, I've got gas of 35 units. And I have a total cost of 40 plus 15 is 55 plus 5 is 60. Now, if I asked you what the average cost is, you might take a look at that $1.50, and $2 and say, I can do that one in my head. That's $1.50. But that's not the correct average we're trying to take. We need to take a weighted average. So yeah, I'm going to whip out the calculator too. I'm actually pretty good at math, but I'm going to trust my calculator more. So if I want dollars per unit, how do I get dollars per unit? Dollars per unit. Well, I need dollars in the numerator and units in the denominator. So what I have dollars of $60 in the numerator, and I divide that by 35 units. And so if I go ahead and take my calculation and take my 60 divided by 35, I'm going to get average cost of $1.71. Now, is that logical? Is it going to be closer to the $2 than the buck? Well, yeah, we got a weighted average. We got 20 gallons here, we got 10 gallons there, and 5. So, you know what? Our $2 milk is the heavier dose of all the milk we're getting. And this is the middle range, but it's going to lean toward the $2 rather than lean toward the dollars off the buck and a half. So if I do $1.71 and I multiply that times my 15 units, I'm going to get 25.71 if all goes well. And so we're going to get our average cost going. And we're going to have 25. So let's see, 25.71. And I told you we had $45 in sales. Okay. And if I take 45 minus 25, that gets me down to 20. Take another 71 cents. I get $19.29. We're welcome to use a calculator. I have no qualms. But that's logical. Average cost is going to be smack dab in the middle, somewhere between the 15 and 25. We know that. Now, if we know what our cost of goods sold is, we know it's $30 here. And so if we have to go back to our formula here, let's go back to our, stretch this out a little bit. And I'm going to go in and I'm using a LIFO basis here. And a FIFO basis here. And an average cost here. I can go right on down and say, you know what? If my cost of goods sold for LIFO, which we just determined up here, was $30, and my cost of goods sold for FIFO was $20, and my average cost was $25.71, we know that this total better, and I'm going to go ahead and zap that ending inventory right now because it's cost of goods sold we're worried about. Readable, easily understood. Okay. So my ending inventory, if I know my total cost was $60, my 30 plus 30 is 60. 30 plus 40 is 60. And my 25.71 has to get to 60. And we said that would be based on 35, oops, yeah, 34.29. Okay. So I'm looking at that saying, oh, I don't even have to go in. I could have done my ending inventory. So LIFO would kind of go backwards. Last in, first out. I sold my $2 stuff first, then I sold my buck and a half, then I sold my buck. I could have backed into this, and this is the check you might want to perform, in saying, well, if I know I sold here 15 gallons and I had 35 available, that means I have 20 left in inventory. So my 20 on a LIFO basis, I sell those. I'm left with my 5 from a buck. I'm left with 10 at a buck and a half and another 5 at the $2. So you can actually do the calculation there or just do the more simplistic calculation of knowing that cost of goods sold and getting inventory must equal the total dollar amount of what's available for sale. And this was the total 35 units for a total of $60 based on what we had. So that's the overview of inventory. It gets kind of confusing. It takes some practice. This is not natural. This is not something that I guarantee you will know, understand, and be able to read in moment's notice. But it is something that you can learn, and you'll probably see a quiz on it pretty soon. So take advantage of this particular video, have an understanding. If you have any questions, don't hesitate to reach out. Look forward to being in touch and thank you for your indulgence. Talk to you soon.